The objective of today's call is for a lot of our guys that is in our premium server that a lot of you guys were asking how to get into trades. You guys are having some issues using the Thinkorswim platform or any other platform that you are using to be able to get in and out of trades. So I wanted to break down, go over how you would enter and exit a trade, and I'm going to show you guys some examples on the desktop and examples on the phone. I'm going to share the screens with both. All right. So for those that being that this is being recorded, we're going to see it on YouTube. So for those that are going to be watching this on YouTube on the replay, so make sure you guys hit that subscribe button for me. Right. I would appreciate this. Does take time to do, and it takes time away from everything else that I'm doing. So I just want to make sure that I'm giving you guys as much info as possible. And for that, all I ask in return, just make sure you guys are subscribing to my YouTube channel. All right. So with that being said, let's get into it. Right. So just some basic stuff for those that don't understand. Some of you guys might already know this already, but some terminologies that you need to know that is going to pop up on the order editor when you're going to fill in to get into a trade or get out of a trade, right? Is understanding what the call is, what put is, what the strike price is, expiration date is, premium. You need to understand those. Those are some basic things you should understand automatically before you get into any trade that you're going to get into. Right. And those things are going to play a very, very pivotal role in terms of you winning that trade or losing that trade, because you can have the most perfect setup on the charts. But if you don't get into the right contract, it does not matter. And this falls into your setup. So anytime that I look at a trade before I get into the trade, I make sure that I can find contracts that make sense, contracts that have high volume, contracts that have tight spreads. Look for contract that's not too far out of the money. So things of that nature, that's what I look at. So for those that don't know, a call is when you think that stock is going to go up. So you'd buy a call, and as the price of the stock goes up, your contract price will go up. So that is a call option. And you do a call option when you think the price of that stock is going to go up. For a put option is if you think the price of the stock is going to go down. As the price of the stock goes down, you make a profit, your contract price goes up. So call for up, think the price going up, puts, think the price is going out, and you make a profit either or. And then if it's going the opposite, that means you're going to be losing. Your strike price, that is your exercise price. Also, that is also known as that's the price where you can buy or sell that stock. If you exercise it, that is when you are in the money. And then for your strike price, I'll show you guys how you can determine your strike price, things that I look at in that nature. So therefore you can understand for yourself. I'm going to give you guys some live examples as well. Right. Your expiration date, that is the last day that the contract will be valid. On or before that day, you will have to decide on three things, which is closing your contract for a profit or for a loss, exercising your contract if you are in the money. For a call option, if the stock price is above your strike price, that is in the money. For a put option, if the stock price is below your strike price, that is in the money. All right. So in the money, stock price for call option is above your strike price. So say if you're in $150 strike price and the stock price goes over that, then you're looking at being in the money. And then vice versa for puts, being in the money. And then that's when you would be able to exercise those contracts. And then the third option that you have is letting your contracts expire worthless, or just letting it expire. And if you happen to be in the money, depending on what broker you have, it may exercise it for you, but automatically they'll close it out for you. But you do not want that to happen. You do not, because you're going to lose everything. You do not want that to happen. Right. And in the premium, that is going to be your ask in the bid. That is the contract price that you're going to be buying. One option contract equals 100 shares. So you always have to multiply the contract price by 100 to get the true cost of those contracts. So say if a contract price costs $1.03, that means the actual true price that you're paying is $103. That is your contract price. All right. And then I'm going to share my screen. I'm going to show you the Thinkorswim platform on the desktop, just so you can see exactly what I'm talking about. And let me know if you can see my screen. Let me share this. 1 second. Can you guys see my screen? Can you see the Thinkorswim platform? Let me know if you can type in yes.
Yes.
All right, awesome. Thank you. All right, so this is the option chain. All right, so this is NVIDIA, NVDA. Right, disregard all the stuff that you're seeing over here. So this is normally anything that I have on my watch list. This is what I look at over here with the multiple desktops I look at, but this is one of the things. But the main thing that I look at once I figure out what direction, whether I'm going to do a call or for a put, first thing that I do, I want to come in here to see how do the contracts look, right? So what I will do, I'll come in here. This is going to be your expiration date. First thing you want to pick out is your expiration date. For day trading, you always want to look at the weeklies. Day trading, you want to look at the weeklies. And the reason why you want to look at the weeklies is because you will find more volume in the weekly contracts. And options contract expire every Friday. Every Friday, options contract expire, with the exception of those ETFs, SPY, QQQ, those volatility stocks, the VIX, SQQQ, TQQQ, and a bunch more. All right, so those, they have 0 DTE, which you'll see. I'm just going to show you, all right, as an example. So this is SPY. All right, so for SPY, as you can see here, this is the 0 days to expiration. All right, but primarily every stock, individual stock, you're looking at every Friday. So let's go back to NVIDIA for you. All right, so you want to look at the weeklies. And even with like SPY, when it has all those expiration, there is 0 days to expiration, you still want to focus at the end, that Friday. And the reason why I say that is because, like, for example, today, the premiums, they were moving extremely, extremely, extremely fast. So what that means is the contract price, the volatility in the contracts were through the roof. So therefore, what primarily on a Monday might be a 5 or 10% loss, on a Friday is equivalent to, you're looking at about 30 to 40% loss because of how fast those premiums are moving, right? So that's going to be due to the expiration date. So when you're picking out your expiration date for the weeklies, you want to look at the Friday, and then, for example, say if it's moving too fast for you, look at the following week's Friday. So like, for example, today is 0 days to expiration. Say if that was too much for you, look at the following week. That would be your next best option. And the reason why, again, is because it has the highest volume. More people are trading with that. Let me just adjust this for you. Let's go to volume. All right, so you can see. So this was today for NVIDIA. All right, this was today. These contracts don't matter anymore. Why? Because they're already expired. But say if we were trading and the market was still open, I would be looking at these contracts. Why? Because I would get the best bang for my buck in terms of volume. And because better volume, therefore, I would have tighter spreads between the ask and the bid. And for the ask and the bid, you always want the contract price to be tight to each other. Primarily, I like it to be within 1 or 5 cents. And the reason why I like it to be within 1 or 5 cents is because whatever the ask price is, and let me show you. All right. So like, for example, this would be next week's contract, right? So this is about 5 cents apart from each other, right? And this is good volume right here. All right, good volume, 5 cents. So like I would be looking at these contracts for next week. And on top of that, it's not too far out of the money and it's not too expensive. All right, it's not too expensive. It's not too far out of the money. These, you can tell there's going to be some volume, where it's Friday, but Monday, these would have a lot more volume than it is at right now. So the reason why I like it to be tight spreads, so where it says $1.05 right here, that means $105 you're paying for that. So as soon as you buy that contract at $105, it automatically goes down to $100. As soon as you purchase it at $105, it goes down straight to $100. So if the spread is about 10 or 15 cents apart, that means as soon as you enter that trade, you'll be down about 10, 15+%. You do not want to start a trade being down so much. You want to put yourself in a position, right? You want to put yourself in a position where you'll be able to give yourself a fighting chance to win that trade. Let's see. Maito, can't hear. Do you know why? Can the rest of you guys hear me? I see what somebody put, they can't hear me. Just want to make sure you guys can hear me.
Yeah, we can hear you.
Okay, yeah. So I think that might just be your headset or whatever you're using, Maito 9905. It might just be you. Other question says, will Thinkorswim require us to cover the full contract cost? We'll need 47K liquid account or to buy one. No. So Tom, good question. So he's asking, do you need to have 47,000, just an insane amount in order to be able to get in the trade? You do not need that. So for example, that option contract that is at $105, you don't lose any more than that. So if you're buying one contract, right, that one contract that you're buying, that's the most you're risking. So if I were to click one contract, right, so I'm going to go to one contract. Let's make this bigger for you so you can see. All right, so this is one contract, right? If I were to purchase one contract, $105, it's going to show me $105 right here. Max loss is $105. I can't lose more than I can't lose any more than I put in. So $105, I cannot lose more than $105. All right, so that's the beauty of option trading. So to answer your question, no, you do not need 47,000. You don't need an insane amount. You just need whatever the cost of that one contract is. All right, that's all you need, Tom. Great question. So going back to what I was saying, for the option contracts, I like the spreads to be tighter, and that's the reason why. So make sure when you're picking out your contracts, make sure that they have tight spreads. And then something else to keep in mind, right? Just because a contract is $9, $10, or you see here close where they're in the money, right? That does not make it automatically a better contract. And the reason why I say that is because you don't have as much room for error. So say if you were to get this contract right here, you multiply it by 100. So you're looking at about $1,000, right? About $1,300, $1,000 and some change, right? So, or even this one, $900, $915, right? So if you wanted to get out of your contracts, if the trade is going in your direction and you wanted to take some profit, if you only have one contract, that's $1,000, right? That means you have no room for error. You literally you have to close that contract out. And then say if you're, as opposed to just going into that one, it's better for you to find a cheaper contract where you can just buy multiple. So therefore you can use that. So therefore you can tread some contracts. So say if a trade starts going opposite direction, but it's not at your stop loss, you're getting nervous, you could start trimming, getting rid of some of your contract. You have more room for error. Or say if you're making profits, right, and you want to set a trail stop and you're like, hey, I'm up 30%. Being that I'm up 30%, let me take some profit off the table. Let me trim half my contracts. So therefore, that right here, you'll be able to secure and lock yourself profits, and you'll be able to protect your capital longer, right? You'll be able to protect your capital. You have a better chance of protecting your capital, and you'll be able to allow yourself to have those gains run longer, whether you leave a runner or whether you leave a trail stop. And I'll show you guys how to do a trail stop as well. Okay, another question. Okay, I was messing around earlier and it rejected me from getting into the trade. Ask must have been something else. Yeah, so just be careful. That can happen. I know there, say if you have a margins account, you have to be very careful not to click the wrong thing, because margin pretty much is borrowed capital. You might on a cash account, you won't see that mistake. You won't see that mistake, so it won't ask you to cover the spread or any of that. But in a margins account, you might run into that mistake. Say if you press the wrong thing, right? So you might start to use leverage that you're not supposed to use. So just be mindful of that, Tom. But good question. All right. So that was the premium, right? So that was the expiration date. So we want to look at the weeklies. Say if you want to do a swing trade, right? If you want to do a swing trade, you're not looking to do like a long swing trade. Personally, I like to look at 2 weeks out. 2 weeks out, depending on where I'm at. Say if Monday to Tuesday, if it's Monday or Tuesday, I'll look at the weeklies. If it's on Wednesday, I'll look at the following week's expiration. Just give me a little bit of time. And that's more so just, I'm looking to just either make a decision within a day or two, right? I'm not looking to hold it for a long time. And when you're in your swing trades, you want to be able to get out of that trade by the halfway mark. So once you get to the halfway mark, the premiums are going to start burning even faster. So if you're in a swing trade, right? Say if you go 2 weeks out, in a week from when you entered the trade, you should already have a decision whether you're going to close that trade or take profit or let it run. Because the closer you're getting to that expiration date, the faster those contracts are going to burn because of time decay. And then the more the stock will have to outperform in order for you to come make some profit if you're losing that trade. So just be mindful. Don't hold the trades for too long. You have to understand and know when to cut something short. But when it comes to swing trading, if I'm just looking just for like a move in a day or two, if I'm looking at like on a 1 hour or the 4 hour, I'll look at the 2 weeks just to be on the safer side because of how the market conditions are. Right. And then say if we're looking at the leaps, then you want to look at the 2 years. You want to go like, for example, you got 2025 right here. But the further you got to remember, the further out you go, the less volume it is, and the more it costs. Right. So the further out you go, the less volume, as you can see here, and then the more you're going to have to spend. All right. Look at these contracts; they're insane. It's not even. Look at the volume. There's barely any volume in here. Right. And we're looking at the 2025 contracts. All right. So just be very mindful of that. If you're looking at leaps, right? If you're looking at leaps, just be very mindful. You want to be out of your leaps, right? By the halfway mark. You're either going to be in profit or loss. You should automatically know what you're going to do with that. All right. So let's go. I'm going to reshare the slides so we can go into the next. Let's go back. All right. So now the next thing that you need to understand. Oops, sorry. Adjust this. Sorry, my headphones just came off. 1 second. All right. So the next thing that you need to understand, right? So say if you're looking to get in a call or put, you have to be able to understand market order, limit order, stop losses, stop limit, trail stop. All right. These are some things that you need to understand. And I'm going to break it down for you so you can understand. Right. So market order, that's when you buy or sell that stock or contract instantly at whatever price that it's currently at. And you will get an instant fill right then and there in the spot. So that's market order. If you're looking to get an instant fill, right? If you're looking to get an instant fill, you would do a market order. And with the market order, that means it's going to fill right then and there, whatever the price it is. So whether it's up or down, it doesn't matter. Limit order, right? For a limit order, that's when you buy or sell that stock or that contract at that specific price or better. So say if that $105, that was the axe price, now I did limit, that means at $105 or better, it wouldn't fill it at anything higher than that. It would fill it at $105 or lower. So limit price, you're going to get that specific price or better. However, it doesn't guarantee you an automatic fill. It will be delayed. Say if the stock is moving too fast, right? And then you try to purchase it at limit at $105, and then it shoots up to $110, $115, you'll have to cancel your contract and redo it because it's gone way too far, or you're just going to have to wait till it comes back down. All right. But market order will get you that instant fill. So you just have to kind of weigh out your options. Personally, depending on how the stock is moving, the price action, I'll determine, hey, am I going to buy a market order, limit order? If it's a slower move, then I'll look to get limit order. If it's a faster move, then I'll do a market order just to be able to get in there. Let's see a question. Diallo, buying far from the money can give profit. Yes, it can give profit. However, it takes long. The further out of money you are, the longer it's going to take for you to make that profit because you have less volume, right? Less volume, so that's not working with you. Being that there's less volume, your contracts, there's not as many people in the contracts. There's not many contracts available. And then on top of that, the stock is going to have to outperform, do a little bit more because of the intrinsic and extrinsic value. So it's going to have to do a little bit more versus closer to the money. That's why I said you don't have to be in the money, but you don't want to be too far out of the money. So just be mindful when you're picking out that strike price. But great question, Diallo. Okay, thank you. I'm having a hard time picking with strike price. Yep. So when you're picking the strike price, just think of it as something that's reasonable and attainable. And think about it, if it's day trading, right? You want to pick something where, hey, worst case scenario within this week is going to get there. All right. Swing trading, worst case scenario is going to get there. So that's something that you want to be mindful of. And that's what you want to think about when you're picking out that strike price, because you don't want something it's unattainable. It's not going to reach it. All right. Then you're just going to put yourself in a mess, and where the contract you're going to end up getting expired worthless because it's not going to be anybody that's going to be interested in buying your contracts. So therefore, you're just going to take an L. Can you buy a limit, then sell market? Yes, you can do. Yep, you can do vice versa. Alex, great question. Yes, you can buy it at market or limit. and then afterwards, you can sell it at limit or more, either or. And I'll show you that. I'm going to give you guys some examples as well. I'm going to share my screen with you guys on the Thinkorswim platform on the mobile as well, so you can see it. So yes, you can buy it at limit or buy it at market, and when you close it, you can close it at sell or market, whichever. Good question. All right. So next would be your stop loss. Your stop loss, that right there, that's what's going to guarantee you a fill out. Say if the trade is not going in your direction. So say if you get into a trade, and when you get into the trade, you're at whatever contract price. So say if the contract, let's use $1, right? Say if that NVDA contract was at $1, right? And you're like, hey, worst case scenario, I want to be able to get out of that trade 20% with max 20% loss that I can tolerate, right? So therefore, what you would do, you would go to your stop loss, and I'll show you that in a second as well too. And you would put your stop loss to be at 0.80 or minus 0.20. So therefore, from that $1, from that 100, so automatically, if the contract price comes down to that price, it would automatically, you would be exiting out that trade for that loss. It will protect you. So when you're getting into the trade, right, you can have a hard stop loss automatically. As soon as you get in there, you can just put the stop loss there, and it will protect you from taking a big loss. And then, oh, hold on, let me go back. What happened? All right, and then the next thing would be stop limit. So rule of thumb, if you're going to have a stop loss, always have a limit. You don't want to just have a stop. You don't want to prepare to lose, but not prepare to win. I hope that makes sense to you. You do not want to get into a trade where, hey, you know where your stop loss is, but you don't know where you should be taking profit. That means you only thought about, hey, losing, but you didn't think about taking profit. That's also a big thing as well. And you can adjust it as well. Once you're in a trade and you are winning, you can go back. So say if you had a stop loss or stop limit while you're in the trade, you can go back and you can edit it. And then that's where the trail stop will come in. But the stop limit, right, will have your stop loss and it will have your take profit. The limit price will be your take profit. So say if we're at that $100, that dollar price or the $100 price for you to get into a trade, right? That's the cost of that contract, $100. So your stop limit, your stop loss, you want it to be 80%, 20% stop loss. So therefore 0.80 cents. So entry price is $100. Your stop loss is 20%, which would be 80 cents. So minus 0.20, that would be your stop loss. So now you want to have a take profit, right? Being that you're using hard stop losses, right? For your take profits, you can have a hard take profit area as well, right? And then you can adjust it based on the price action. You can adjust it based on price. Or if you understand the price action, you can adjust it like that, right? So with your limit, what you would do, you would just add whatever you wanted to get out. So your limit price could be $1.20. So that means 20% profit. So, or you can do 40% where you're looking at a 2-to-1 ratio. So all varies depending on what you want to get out of it. That does not mean it's going to happen. That does not mean it's going to guarantee you that profit. It's if it comes to that price, it will automatically fill full profit. And if it comes to that price for loss, it would automatically fill for a loss. So it protects you so you from having to lose more, and it also lock in your capital for profits if it hits that. Let's see, Tom, another question. Once we are in a trade, in order to exit, we create an opposite order and Thinkorswim. Now I'm going to show you. So you can go back and edit it. I'm going to show you the same way that you would close it would be the same way that you would edit it. So I'm going to show you that as well too. Right after I go into trail stop, I'm going to share my screen so you can see that part as well. But good question. Hold that thought. I'm gonna answer that question for you. Right. So a trail stop. So say if you're in your stop limit or you're in a stop loss and you're winning that trade, and as you're winning that trade, you want to protect yourself. Right. You want to protect yourself from losing. You want to protect yourself because you're winning. You're making profits. So because you're winning, you're making profits. What you want to do, right? What you want to do, you want to set a trail stop. I'm going to show you guys an example, right? Real quickly. So you can, anytime that we're in a trade, it's going to come to a point where I'm going to say, hey, take a trail, add your trail stop. Let me show you. So for example, can you guys see the screen? All right, awesome. Yes. Okay, got it. Awesome. All right. So, for example, right? So this was NVDA. This is the last trade that I had gotten into, and we were winning that trade. And then there came a point where we were up. I think it was about like 10%. Let's see what we got into the trade. The contract price was at 81 cents. Right. This was the trade. The contract price was at 81 cents. And then we were winning the trade, right? Went from 81 cents to 90 cents. Went from 81 cents to 90 cents. So right then I'm like, okay, we're up about 10 cents on our contract. So this is where I'm like, hey, add a trail stop. So to add that trail stop, the same way that you would go to close your contract, all you're doing is you're going to close the contract, but you're going to go instead of going market or limit, you're just going to go trail stop. And when you go to trail stop, you're just going to subtract whatever the contract price is, whatever you want to get out of it, which is whether it's -5. So say if it's at $1, so being that this is at 90 cents, you can put your trail stop at 85 cents. So therefore 5% less than that, or whatever that equates to, right? So that means automatically, if that trade were to flip and go the opposite direction, it guarantees you a win. Or something else, rule of thumb, right? Because trail stop always has to be above your entry price. So worst case scenario, you can put your trail stop a cent above your entry So automatically think of it as like you're breaking even. You're not losing anything. You're not losing anything, right? You're going to get 1% out, at least 1% out of it. So automatically is going to protect you from losing, right? And now you're going to be able to walk away with an automatic fill for profit. And I'm going to share my screen on the phone just so you guys can see. I'm going to show you guys how you would enter it, how you would get in it. Let me see. So it's 1 second. I'm going to flip this. So 1 second, guys. Give me 1 second. I'm just gonna set this up for you guys. But I'm pulling up the Thinkorswim on my phone so you guys can see. So I'm just trying to share this. Can you guys see the Thinkorswim? Well, can you guys see the phone, the Thinkorswim on the phone? Hold on.
Yes. Yeah.
Okay. Hold on. 1 second. Hold on, guys. Hold on real quickly. Well, I'm gonna try like back in 1 second. All right, let's try this again. Sorry about that. All right, there we go. You guys can see it? Can you guys see it? Just
Yes.
all right, awesome. All right, so we have the Thinkorswim platform. So this is on the phone right now, right? So this is on the phone. So what I want you guys to do, we're gonna I'm going to show you an example of how to get into a trade and then how to get out of a trade. And I'm going to give you an example. Let's see. The last trade was the NVIDIA trade that I showed you, right? So the expiration date was for today, but we're going to look at next week's expiration date. All right. So let's pull it up. So all you're going to do when you Thinkorswim platform, right? So on the Thinkorswim platform, once you come in this page right here is the general page that you should see on your phone. So at the top right, where that little magnifying glass is, all you would do, you tap that. Once you tap it, what you want to do, you want to type in whatever stock that you're looking to trade. So primarily anytime, so something that I do every time for the guys that are in my premium server, anytime that I get into a trade, I always give everybody a heads up. I always let you know in advance what contract price that I'm going to be filling, right? And this is to get you prepped, to get you ready. So what you would be doing, so like with the NVIDIA NVDA trade, I would tell you, hey, I'm looking to get into NVDA, be ready if I send it. So what you would do, all you would do, you come in, you type NVDA, right? And once you type it, you want to go to whatever the contract price. So automatically, it might come up to this right here to the charts, where you see the tab where it says chart news. What you want to do, you want to make sure that you go to the options tab, right? You want to make sure that you go to the options tab. When you come to the options tab, this is your expiration date is going to be over here. Your expiration date is going to be over here. So what you want to do, first thing you're going to do, you're going to go to the expiration date. So the signal that I had sent out was NVDA, July 28, $490 call at 81 cents. Giving that those contracts expired already. So we're going to look at, I'm going to pick a random contract for August 4th, which would be next Friday's expiration, right? So say if I wanted to get into some calls. So on the left side, we have our calls, right? So this is our option chain. For those that don't know, this is the option chain right here. So on the left side are going to be your calls. On the right side are going to be your puts. So something that you always want to make sure that's properly on, where it says strike in the middle, you see it says strikes. You want to tap that. When you type that, you want to make sure that all your strikes are on. You want to make sure that all your strikes are on. All right. And then just make sure that's done. Once that's done, you want to come in here. You're going to go to the expiration date. We're going to go to August 4th. On the left side, we have our calls. On the right side, we have our puts. And in the middle is the strike price. All right. Remember, the strike price, that's your exercise price. So we're looking to get into some calls. So say if for whatever the reason I sent that signal out, right, we're going to get into some calls. So we're going to look at let's look at the $510 strike price. We're going to look at we'll choose that as an example, right? It's at $105. So it would be this one right here, right? So this is the $510. So it's this strike price right here, as you can see, right? So what you would do as soon as you tap it, right, this page is going to come up. This is your order editor. This is the page that's going to come up right here. When this page comes up, what you want to do, you see where it says buy, you see where it says sell. You always want it to say buy. We're always buying. We're not selling. Also, let me go back one more time, right? So before I forget, at this top right here where it says strike, next to it, you see it says volume. Next to it, you see it says ask and bid, right? So you always want to buy it at the axe price. Always want to buy it at the axe price. So say if you tap bid, it's automatically going to go to sell. You always want to buy at the axe price. So axe price, it'll take you here, right? And then once it gets you here, you want this to be green. You want your buy to be the green. You don't want it to be sell, right? So this is going to be here. And what you would do, you would adjust how many contracts that you want to buy. All right, whether it's 1, 5, 10, however many contracts you want to buy. Mind you, I'm giving you the heads up already about what contract that I'm getting ready to fill, I'm getting ready to buy. So you know exactly what we're getting. So now, therefore, in terms of your risk management, you should know by looking at those contracts. So this contract, one contract costs $105. So automatically, based on your account size, you should know what your risk management should be. So say if you have a $10,000 account size, you'll know, hey, between 1% and 5%, that's the max I'm going to go into a trade. So that means anywhere from 1% to 5%, that's where you'd be looking to get in a trade, right? That can range from $100 to $500. If you want to go 10%, that would be, you're looking at $1,000. So therefore, you wouldn't buy anything more than that $1,000. Say if you wanted to go 10%, but 5%, that means $500. So what you would do, right? You would pretty much be right there. So it said 528, but being that you want to manage your risk. You want to keep it below $500, so you get 4 contracts. So say if you go 1 to 5%, and for those that don't know what your risk management should be, right? I have a risk management. I'll show you guys afterwards. I'll show you guys in the server as well. I have a breakdown of what you should be using to get in every trade. I have a breakdown for you guys to see, right? So what you would do now, right? Based on what your risk manager, you'll pick out how many contracts, and then when it says market or limit, stop. This is where you want to pick between market order or limit order. Remember, like I said, market order, you're looking at an instant fill. Limit order, you're looking at 105, $1.05, $105 or better. One option contract, again, remember, it goes to 100 shares. So therefore, you have to multiply 100 times the 105. And we're getting 4 contracts, right? So what we want to do now, right? We want to look at buying it at the stop loss. I'm going to show you. We're going to do a stop loss just so you can see, right? So what you want to do, you're going to toggle it over to where it says stop. And once you toggle it over to where it says stop, the entry price is $1.05. That's your entry price. So where it says stop, what you want to do, you want to adjust that to whatever you want to get out of the trade with. So say if 10% or 15% is where you want to get out, you just adjust it or type into whatever you want to get out. So say if $1.05 and you want to get out at worst case scenario, 95 cents, right? All you would do, you type that in. So if that stock were to come down to 95 cents, automatically it would fill for a loss. You would not lose any more than whatever that percentage is, whether it's 10% or 15%. So just like I said, I give you a heads up. I'm getting ready to get into this contract. So all you're doing, you're just sitting tight and waiting for me to come and send out the signal. When I send out the signal, right, you have your stop loss set already. So as soon as you enter that trade, you don't have to worry about, oh my God, the trade is going against me. Do I close it and do I not close it? You automatically know what you're risking for that trade. You're not risking any more than that 10, 15% because you already did the math. You already did the numbers. And then just like I said, if you're going to have a stop loss, you want to also have a limit. You want to not only prepare for a loss, but you want to prepare for a win as well. All right, you want to prepare for a win as well. So what you would do, where it says stop, you're going to move it over. You're going to go to stop limit. And for stop limit, right, stop, remember, that's your stop loss. The limit, that's going to be your take profit. Where it says MAN and underneath it, it says limit, that's going to be your take profit. And in there, this is where you're going to adjust it to where you want to take profit at. All right, so you want to adjust it so where it can be 15, 20, 30%, you do the math, right? You keep it 2 to 1, so where it'll be, say if you're going 20% profit, you can do 10% stop. You could adjust it however you want based on whatever your risk management strategy is, or however much you're looking to get into that trade. Every trade that I go into, my goal is not a specific percentage, is I trade based on the price action. However, you don't have to hold it as long as I do. And you don't have to take profit when I do. This is why I always say take profit when you're comfortable. So therefore, you can adjust it. You can do whatever you want with it. So this is where if you want to get out with 30% profit and the stock is doing phenomenal, right? Being that you have your take profit in the stock, if it hits $1.30, right, it's automatically going to get you a fill. So you're going to have automatic stop loss at 95 cents. And you're going to have an automatic take profit at $1.30. Either direction, you're going to have an out. And all you would be doing at the top right where it says review, all you're going to do is you're going to just tap the review and it's going to bring you in here, right? Once you tap that review, it's going to bring you in here. As simple as that. And then at the bottom, you're going to tap send and then it would get into the trade. So now I'm going to show you if you are in profit, if you're making profit, right? How you can set a trail stop. So say if we're winning the trade, right? We're winning the trade. Trade is going well. You had a stop limit, right? So now you want to adjust it. So what you would do, you see where it says positions, you go to positions. There's nothing open now, and this is a coaching account. But say if you want to trade, it would show a trade there, but it's nothing now because the market is closed and we're not in anything. But you tap in a position and you click on whatever open position that you have. And when you click on it, it would show up like this. This is what it would look like. So being this is what it would look like, what you would do, right? It's automatically going to say sell. You would just switch, as opposed to market or limit order. You want to do a trail stop. So you're going to move it over, look for the trail stop, go to trail stop. All right. So instead of market or limit order, you're going to do a trail stop. And for your trail stop, remember, it has to be above whatever the entry price is. Whatever you enter that trade at, whether it's $1, it has to be above $1 because it guarantees you an automatic fill for profit. Right. So just go back just so you can see. We're looking to get out of the trade. This is the trade is $1.05. Right. That's how much we paid for it. And say if the contract price right now is currently at $1.15, right? $1.15. Right. Well, what you would see, you'd say sell right here. So you'd move that to trail stop. Right. And then trail stop, say if it's at $1.15, where it says mark and it says minus 0.10. I'm going to show you this right here. I'm adjusting it. Right. So whatever the current contract price is, you're just going to toggle that over to however much you want to subtract from that price. And that will be your fill price. So say if it's at $1.30, you entered at $1.05, and you want to get out worst case scenario, 15% profit, $1.20, or whatever the math is on that one. What you would do from $1.30, you just do minus 10. Say if you want to get out at $1.25, you would just do the minus 0.5. So automatically it would fill at that price. It would automatically give you a fill. So you won't have to worry about anything. And you can always go back and adjust. So say if the stock is continuing to go up, it's continuing to rise, you can go back, cancel, and replace that order. And then you adjust it. You keep adjusting it, right? Or you can just leave one runner, just let it run, right? And adjust it for you to take profit in that last one. And all you would do at the top right, you would click on review and then come to the bottom and you would hit send. As simple as that. And that's how you get out of a trade. That's entering the trade and that's getting out of the trade. Do you guys have any questions regarding that? Does everybody understand? Just want to make sure, does everybody understand that? Or anything you need me to run through again? All right, I'm seeing some questions. 1 second. Matthew Montgomery, my boy, put in that work on a Friday night dedication. Shout out to you, Matthew. It's about you guys, not about me. I just want to help you guys to the best of my ability. It doesn't hurt or kill me to take an hour or two out of my day to give you guys as much game as possible. So, well, thank you guys for being on here. All right, because you didn't have to be on here on a Friday night as well. All right, Mariah, I'm sorry if I pronounced your name wrong. Can you go over how to put a price for a trail stop again? Yep. You got it. I got you. 1 second. I'm going to show you. All right. So I'll show the trail stop again for you. No worries. I got you. All right. And then Alex, you're showing that desktop. Yep. I'll show you on the desktop as well too. 1 second, Alex. All right. So I'm going to go for the trail stop on the phone. So where it says positions at the bottom, you see where it says trade orders. All right. When you're in your position, we're not in anything right now, but when you're in your position, all you do, you tap on that positions and your position will come up and you just click on it. When you click on it or you tap on it, what's going to happen, the page will come up like this. It will say sell. It'll be red just like this. And all you're going to do where it says limit, you're just going to toggle that over to trail stop. Once you get the trail stop, whatever your entry price was, it has to be above that. So those contract costs $1.05. That means $105 you paid to get into that contract. And say if the current contract price is at $1.50, right? Say if it's at $1.50, you're up 45, 50%, whatever the price, you're up a big amount, right? And you're like, hey, I'm up. I think the stock will continue to go up. Or I sent out the signal to say, hey, add your trail stop, which you would do. You would come to the trail stop and you adjust it. So from $1.50, say if you wanted to get out with 40% or whatever that percentage is, or 35% at $1.40. So all you would do from the current contract price, you're going to subtract where it says mark, you're going to subtract that from it. So say if the contract price again is at $1.50, you're going to subtract that 10 cents from it, that means it would fill at $1.40. Say if you wanted to fill at $1.45, that means all you would do, all right, 0.5 at $1.45, it would get out for you. All right. And that guarantees you an automatic fill. It guarantees you that you're going to get profit. If the trade or the flip to go against you, you know you're going to get a fill. You're going to win that trade no matter what. And that's how you do it. And at the top right, all you would do at the top right, you just tap on the review. When you tap on the review, you hit send. And then once you hit send, and then you're good. You're in there. As simple as that. All right. Something to be mindful of too as well. Where it says quantity, right? Say if you just want to take profit in a couple of your contracts and then add the trail stop, or you want to add the trail stop. So what you would do is, right, say if you're like, hey, I have 10 contracts, right? And I want to just leave a runner. So you can do market or limit, right? To get out, market or limit, all right? You close out how many contracts? So right now we have 10 contracts that are active. So therefore we want to get out of non-contract. So you close out that non-contract and then you'd go back for that one contract and you can add a trail stop. So there's a lot of ways you can play with it. All right, let's see. The other question, was that helpful? Did you understand that, Mariah? And for those that are on YouTube, I'm looking at the Zoom chat, by the way. So I'm not just talking to myself. Because if people are like, yeah, this man is crazy. He's over here a whole hour.
This is Stephanie. I had a question. Can you hear me?
Yes, I can. Go ahead.
Okay. So if you put in a trail stop and it goes even higher and you change your mind, can you just go ahead and buy immediately without doing any kind of readjustment?
So let me just rephrase just so I can understand correctly. So you're saying that if you're in the trade and you already added a trail stop, right? And then you want to buy more contracts?
No. Okay. So if I got a trail stop, it's going higher than that trail stop that I put in.
Correct. Right? So you just go back and adjust it. So it doesn't fill. So it wouldn't close until you close it if it keeps going up. So this is where I say you would go back and you would adjust it, cancel it, and replace it.
Okay, that's the only way that I could buy it immediately. I gotta just at the higher price.
Yes, but remember, you're not buying it, you're closing it.
Closing it.
So therefore, when you close it, you'd be selling that contract.
Gotcha.
All right. Good question. And then also, Alex, I didn't forget about you said show you on the desktop. I'm gonna stop sharing the phone. But real quick before I stop sharing the phone, is everybody good with the Thinkorswim platform on the phone before I go to the desktop? Let's see, so make sure you guys good. All right, yes, okay, great. All right, so I'm gonna stop sharing this. Let's see, does the let's see one more. Marillis, I'm sorry if I'm pronouncing that wrong as well. Does the trail stop keep moving? It goes up? No, you have to adjust the trail stop yourself. It doesn't keep moving. You have to move the trail stop. You have to move the trail stop. The trail stop does not move. You have to move the trail stop.
So, Junior, can you hear me?
Yes, I can hear you. Go ahead.
All right. If you want to add the trail stop and then where it says mark, confused. How do you calculate where it says mark?
Oh, you just have to pull out a calculator. Go old school. Simple as that.
Because I see -5 or.
Yep. So you'd have to do the math. So like, say if your entry price was at $1, which is $100, right? And then the contract is up at $130, which would be at $1.30. That would be the current contract price, not your entry price. Your entry price was $100. It's currently up 30% at $1.30. So all you would do where it says, let's go to the trail stop so you can see. Switch. So all you would do, being that it's at $1.30, if you wanted to go out with, let's say 15% profit, worst case scenario, right? Where you give yourself a little bit more room, hey, the stock has room to go, but it might come down a little bit, but it's just going to come down. You see, you have a support level, you have your price action, you're looking at, you're like, it's going to be good. It's going to you know, you're going to be good. You have nothing to worry about, right? So then you say, hey, I want to get out with just 15%. So what you would do where it says mark, you just do minus 0.15. So that means that would guarantee you that 15%. So it would take away from whatever the current contract price is at. All right. So remember, takes it away from the current contract price. And that always has to be above what your contract price is, what you paid for those contracts. You'll never be able to do less than that, because then that means you would have to do a stop loss.
Got it. Thank you so much.
You got it. You got it. All right. All right. So now let's go into the desktop for you guys. Let's see. All right. Man, my eyes are getting so red. I got this light beaming in my eyes. Sorry, guys. All right. So I'm gonna share the desktop for you guys. Let's pull this up. One second. I'm gonna share my screen and you can let me know when you see it. If you guys see me looking a bunch of different directions, that's because I have multiple screens in front of me, so don't be alarmed. So let's see here. All right, can you guys see that screen? The Thinkorswim platform, can you see it? So I'll make sure. Yes, yes. All right, awesome, awesome. All right, so let's give an example. Now let's take a look. All right, so let's look at, let's go August 4th, same thing. We're gonna scroll down. This was the contract we were looking at. So remember, the left side are calls, same thing, pretty much the exact same thing from where on the phone, where on the left side of our calls and on the right side of our puts, the same thing you're looking at. All right. And then if you guys notice right here, this is where it says ask, this is where it says bid. This is what I was talking about with the contract price. And then you see where it says volume. These are the two main things that I focus on. I don't care about the open interest. I don't care about all the other stuff. This is the main thing that I focus on, the volume. All right, because that's what's going to move the contract. That tells me a lot that I need. Pretty much everything that I need to know is this contract moving? And I'll also show you guys how to run a scan in a second as well, so you can find out what contracts are moving, right? If you're looking for the best contract, I'm going to show you guys a cheat code as well too, right? So what you would do in here, you'd go right here, click on the ask price, the contract that you want to purchase. Let's make the screen bigger for you, right? And you would adjust to how many contracts that you want to buy. All right, so say if you want to buy one contract, so you're gonna go. Remember, this is a call right here. As you can see, the left side are calls, the right side are puts. The middle right here, this tells you the expiration date, and this tells you your strike price. And you always want to make sure that your strikes are set to all, right? Not the default where it might have 4, 8 of them, or 10 of them. You just want to make sure that's set on all, so you can see everything. So all you would do, you see where it says order, all right? This area right here, you're gonna click that. When you click on order. Right here, when you click on order, what you want to do, you can do your market, you can do your limit, whichever one you want. Right there, you're going to click it, whichever one you want. And then say if we're going to do a stop limit, let's show you how to do the stop limit. So say if you want to do your stop limit, as you can see right here, all you would do the same thing, you would adjust it. You would adjust it. So your stop would be here, your limit for your take profit would be here. So this on the desktop, it will tell you what the price is. So the desktop will give you more info. However, there's more steps in the desktop when you're looking to get a fill. In the phone, it will fill a little bit faster than in the desktop, which is weird, which is very weird, but it is what it is. All right. But you got to go, whatever works best for you, just go with that. So for a stop limit, the same thing. So we came in here, all we did was click on stop limit. All right, when you click on stop limit, you're gonna adjust it. The contract price is currently at $1.05. So say if we want to take profit at $1.15, all right, whether if you do the math, I don't know if that's 10, 15%, all right, whatever that amount is, that's the price that you want to get profit at, you just adjust it to that. Say if your stop loss, you want it to be 10% stop loss or whatever the percentage, you just adjust this here and you would just hit confirm and send, and then this would pop up, right? Once this pops up, all you would do, you'd hit send, and that will get you into the trade. That's all you would do to get into the trade, all right? Just like that. Say if you want to, once you're in the trade, all right, we're not in anything right now and the market is closed. However, you'd come here where it says monitor, all right? And then it would show you what trade you're in, and all you do, you just right click it and you can edit it, all right? And you can close it, but being that we're not in anything right now, you're not going to be able to see anything. But all you would do to come in here, you'll see the trades that you're in, and then you can manage your trade. It'll tell you whatever orders that you have working. And then I'm going to show you, give you an example. So once you go to edit, say if you go to edit, all right, being that you're looking to close it or do a trail stop, whatever you want to do, it would pop up like this. It would be red. So just like this, it would say sell, whatever the amount of contracts that you had was just like this. And all you would do where it says order, you're going to come here and you can do trail stop. And just like I told you guys before, for the trail stop, it always has to be above what your entry price was. So say the entry price was $1.05, $105. The stock is currently up. You're currently winning and you're up about 35%. The contract is up, $1.30 or $1.40, whatever the amount is. And say if it's at $1.40, you're like, hey, I want to get out. Worst case scenario, $1.25 or $1.30, right? 10, 15%. You can do the math, or 20%, whatever that percentage is. You just adjust it. And in this amount, you're subtracting it from the contract current price, not the price that you entered the contract. You have to subtract it from the current price of the contract at the time that it's moving. And then you hit confirm, and then you would hit send, and it would just be just like that. All right, does that make sense? Do you guys understand that part? Let's see. Yes, all right, awesome. All right, and I'm gonna pull up another example just so you can see. Let's see. One second. Let's see here. All right, can you guys see the Discord server? All right, awesome. Yes, okay, great. So for those that are new, right, that are not familiar with the server, so this is how to operate. This is what you should be doing, how to navigate through so you're not lost or overwhelmed, because it can be a lot of information. It could be a lot. It can be overwhelming as soon as you get in there, because there's a lot that's happening. And then I'm very active. I type very fast. I give a lot of info, show a lot of charts. So there's a lot that's happening. But it's very easy to navigate once you understand what you should be looking for. So in this right here, in the watch list, this is where I'm giving you the breakdown of why I'm getting into the trade that I'm getting into. So before I get into the trade, I'm going to show you, I'm going to let you know and explain, hey, I'm looking at this setup, right? I'm looking at this setup. Alex, I see your question. So give me 1 second. I'm going to answer your question. All right. 1 second. I'll answer your question. All right. So I'm looking at the setup in here, and I'm going to let you know, hey, I'm looking at this specific thing. This is why I'm looking to get into this trade. So let me just show you. So I'm going to give you some examples. All right. So this was, what is this? So this was Amazon. All right. So Amazon, I saw like a bear flag was happening, right? And I saw that we were rejecting off the 8 EMA, which is this purple line right here. So this is just simply just me breaking down what I'm looking at for the trade. So therefore you can understand this is the potential trade that I'm getting ready to get into, but I'm explaining to you and breaking it down for you. All right. If anybody just send me a message, I'm going to get back to you when I get off here. All right, guys. So any messages, I'll get back to you guys when I get off here. So I'm giving you the breakdown. What you want to look for is anytime that I say I'm looking at whatever I'm looking at, I will tell you the contract price and I will at everyone. This is the thing you want to pay attention to. So say if you're like, hey, I don't care for all the other stuff. I just want to know when I should be ready to get into the trade. You want to look for this. I always say I'm looking at this. Be ready if I send it. Let me just show you some other scroll so you can see. Just like over here. So AMD right here. I'm looking at the AMD July 28th, $115 call or $116 call. Be ready if I send it. So just look at this. And the reason why I give you two options is if one contract is running too fast, where it'll get too costly too fast, and this would be the next best contract, right? So therefore, this would be the second option, depending if it's moving too fast, or say if it comes back down, right? We get a bounce or we get a rejection, then I would go with this one. But if we still continue going, I would look at the next best contract that is affordable, right? So, and then I would look at the one that is small account friendly. So if it gets too much where it's over $130, I wouldn't give you that contract. So I make sure to keep it below that $130 threshold so everybody can afford to get into a trade, even if you have a small account or not. All right. So right here, this is what you're going to look for. And for this, once I let you know that, this is when you want to pull up your screen. This is when you want to pull up your order editor right here. So this is when you want to have it ready, right? This is when you want to have it ready, because this is when I'm going to send out the trade, because you already know what I'm looking at. So this is where you want to pull up your contract, have it set, all right? And then you wait for when I send out the signal. So now when I send out the signal, being that I already gave you the heads up here, what you want to do, right? What you want to do, you want to look at, back up, you want to look at the day trade signals, the alerts, right? And you can silent the chat room, right? You can mute it, because I know there's a lot of, we have members that chat on it. So they might say, if you're waiting for the signal, you might see other notifications pop up, but you can mute everything else and just leave those two open, because I'm the only one that send out alerts or signals or say anything in those two. So all you would be doing is waiting for day trade or swing trade, whatever it is, when I already gave you the heads up. So whatever the contract price is, so like for example, with the AMD, whatever the contract price is, right, you have it prepped and ready and you're looking at it. So when I send it to you, the contract might be up or down or might be the same, because it's always constantly moving, right? You want to look to fill it with, if it's within a 5 cents range, within a 5 cent range, right? Within a 5 cents, because there's a little, I find the contract that gives you a little bit of wiggle room where you can get in there, even if it's 2 cents late, 3 cents late, but you want to try to keep it between 1 or 5 cents so you're not overpaying for it. And if that contract is moving too fast, right, or if it's too high, then I would look for another contract. Or you can just simply write in the chat room, hey, what's another contract? And I'll try to get back to you as soon as possible, right? And then after I send out the signal, right, you're already in the contract, right? You filled it, you added your stop losses or your take profit. So as soon as we get in here, if you're we're winning the trade, as I'm keeping you posted of where the contract price is. So like we entered this trade at 81 cents. It's at 90 cents. So anytime you see me, I'll tell you, add a trail stop. Automatically now you should be going, all right? As soon as I said add a trail stop, we're moving, you're winning, you should automatically pull this up, right? And you want to go start editing. And then what it's going to say, it's going to say sell, it's going to look like this. And you want to start editing it. Right then and there in the spot, you want to start editing to your trail stop, where whatever you want to get out, and then whatever the amount of contracts that you have, you want to come in here, you want to do your trail stop, you're just adjusting it, and then you hit confirm and send. And then you're just sitting tight. All right, you're sitting tight. And then I will say, hey, you can take profits when you're comfortable. That means when I say you can take profit when it's comfortable, that means it's normally a good price for you to start closing out your contract, start trimming it, or you can adjust your trail stop higher where it's closer to that price that it's currently at. So therefore, you're walking away with more profits, right? So once I say this, I'm getting ready to close out my contracts. I'm getting ready to take profits. So you have to get ready to take it yourself, because I'm in the order to editor. I'm on my screen. I'm getting ready to close out the contract, right? And then as you'll see me say, I'm going to take it. But as soon as you see me say take it when comfortable, don't wait for me to say going to take it. That means you should be starting already. You should be starting already. You should have it prepped and adjusted, and I'll let you know, hey, I'm going to take it. There may be time where I might not be able to type fast enough if there's a change in the direction in the price action, where I'm letting you know I'm going to take it, even though I'm like prepping and doing the same thing that you're doing. Mind you, I'm sending you out the info and then I'm going to do it, right? So the same amount of time that it's taking you to do is the same amount of time that it's taking me to, if anything, it's taking me longer because I'm giving you the heads up before I go and do it. So just be very mindful of that. So you just don't wait for me to say go and take it. So just look for this right here and I'll add everyone. That means boom, start taking your profit or start closing it, or you can just close it all together, right? Or you can just keep a trail stop, or you can just take profit and leave a runner, whatever you want to do. And then once I close it, then I'll come in here and I'll let you know that I closed out my contract. So don't wait for me to send this signal where it says closed. Because if you notice, closed with a D in it, that means I've closed it already. I told you I was going to take it, right? I told you I was going to take it. I was going to close it already. So therefore, you should be already closing your contract. And if you want to hold it, just hold it at your own risk, and you want to make sure that you have your trail stops, right? Does everybody understand? So I want to make sure everybody understands. Let's see. Yeah. Okay. All right. Now to answer your question, I see Alex. Do you usually enter with limit orders, a market order? In your opinion, what's the best? It all varies. It all varies based on the price action. So I'm going to show you an example. All right. Great question, by the way. All varies depending on price action, and I'm going to show you. Let's see. So, say if let me move this. All right. So, say if I'm looking to get into the trade, right? This is Amazon. Let's take a look here. So, say if I'm looking to get into a trade, all right, and I'm like, I see a breakout getting ready to happen. I know once certain breakouts, right? Say if we break, I know we might be taking off. You might get a big candle, all right? You might get this, right? Or say if the price action, the slow price action, where I'll just do limit. But say if I see the stock is moving like a Tesla normally, I'm going to show you the candles on Tesla so you can see what I mean by, look at the size of these candles on Tesla. All right, look at the move. This is a $1 move on one candle. So say if you're trying to get in limit and it takes off, you might miss your spot. You have to redo it again. So it all varies depending on how the price action is, how fast, and also the other thing, depending on what the buying pressure is. So which this down here, if I'm seeing that we're getting a lot of buying pressure, which are these green candles, right? That tells me, all right, I got to get in here. All right. So I'll do a market order to get a faster fill. Or say if I do a limit order, it doesn't fill, I'll cancel and then I'll do a market order. But it all varies. No, I don't go in with one specific thing. I just look at what the price action is, and that will determine what I do. But great question, by the way. Let's see. Next question. Oh, you the man. All right. Thank you, Tom. I think that makes a lot of sense. Do you guys have any last questions? Any more questions? Or do you guys understand everything? Mercedes. So 10 contracts equals 100 shares. So if the shares go up $2 up, make 2,000. Yep. So think about that. Yep. One option contract equals 100 shares. So 100 shares, you times that by 10. And then, yep. So you're looking at $1,000. And then nope, that's different. So, oh, I see what you're saying. So say if the stock price go up by $2, all right, that doesn't mean you'll get $2,000. It all depends on the contract price. But if your contract price goes up, right, you just have to multiply it, whatever that is, and just do the same thing. You just multiply it. But yes, and also you will see the math. It will show you that as well. You will see the math there as well. It'll show you exactly what that is. What about those EMA lines? Mercedes, let me know if you understand that. But pretty much yes, but you'll see it there. And then Alex, what about those EMA lines? How do you add those and how do you read them? We could be here all night, but I'm just gonna show you how to add it. I won't go into too much details. I can do another I can do another webinar whenever I have time, either in the coming weeks, where I can get into it a little bit deeper. But I'll show you how you can add it. Let's see. And then Mercedes, yes, kinda. So I'm guessing that's a no. But but just say if you have yeah, use 10 contracts, $100, $1,000. The contract goes up $5 to $105. So that means it's $5 on every contract. So you times that 5 by 10, that will give you your overall that you'd be making in that. So whatever one contract goes up by, you just times that by however many contracts you have. That will give you the amount right then and there. And then yes, so Alex, to answer your question, let me show you. So, all right. So let's see, let me bring this down. So I'm gonna run through it real quickly for you guys. All right. So this is the 8 EMA. This is the 21 EMA. This is the 50-day SMA. This is the 100-day SMA. This is the 200-day SMA. So they all vary. I use them for different things depending on the time frame. The 1 and the 5 minute, that's what I'll use. The 8 EMA and the 21 EMA. And the bigger time frames, and I'll look at the SMAs. All right, so different things for different prices, different time frames. So to add it, what you want to do on the Thinkorswim platform, you see where it says studies? You're going to click that. Once you click that, it's going to say edit studies. So what you want to do, you're going to click edit studies. All right. When you click edit studies, this will pop up. All right. That will pop up. Once that pops up right here, you can write whatever all you do in here. You'll just write whatever you're looking for. So we're looking for the EMA. So you just type in EMA, exponential moving average. All right. Let's pull it, exponential moving average. Boom, right there. You see moving exponential average right here. You double click that. Once you double click that, it'll pop up right here. And then you can click it. You can put whatever color you want it to be in. All right. And then I like the 8 EMA. You can adjust it. And then there you go. And then you just hit apply. You hit OK. And that's how you'd add it. And for any indicator, that's how you'd put it. And then the indicators that I have, as you guys can see, 8 EMA, 21, the 50 SMA, 100 SMA, 200 SMA. I have the RSI, the MACD, and then the volume. These are the only things that I use. All right, let's see. Next question. Do you have videos how to set up the Thinkorswim? How top added those indicators? I just gave you a simple example, but we would have to do a different webinar, because if not, then I'm going to be here all night, guys. I'm going to be here all night. It's a Friday night. I do want to enjoy the night too. It's going to be here all night. Let's see. So you have exponential moving average. It's two different things. One is, so the EMA is better on the shorter time frame, right? You have the SMA simple moving average. So that's the weighted average for the EMA. So I'll show you. I'll show you here. So I'm going to give you a better answer. So I'm not giving you a quick answer so you can understand even better. So here's what I would recommend for you. Let's see. So in the server, right? In the premium server, what I would recommend when you go to, click here and click on here. This video right here, I break down the difference between them so you can understand it yourself. So all the technical indicators that you're seeing on my screen, correct. The simple moving average versus the exponential moving average. So I break it down, everything in here for you. So in terms of like how to use it, I explain it. So I would say watch this video, right? Because I don't want to just give you the short answer, but this right here, it will go more in depth for you. All right, so I hope that answers your question. Any more questions? Last question. Going once, going twice. Let's see. Definitely watch. Okay. Awesome. All right. So let's see. Where is the risk management section? Great question. So when you join the server, when you get into the server, right? Once you get in, what's going to happen, right? You're going to see info start here. You want to get here. And what you want to do, you want to click where it says start here, new members, all right? It's a new member guide here. And at the bottom, literally, first thing you're going to see is here, risk management strategy. So depending what your account size is, so say if you have an account size of $1,000 or less, literally I break it down, 10 to 15% per trade. So you're looking at $100 to $150 max that you're going into that trade. And then you can use a 15 to 20% stop loss, just like I showed you guys how to enter, do a stop loss. That's what you would do. And then you'd only be risking about 3%. So I break it down for you. And then I also have a video on the Thinkorswim platform, which I just showed you guys that. And then also another setup and a bunch of other stuff as well, breaking down how to understand the contracts and how the signals are sent, which I explained to you guys that already. All right. Any last questions, guys? All right, looking forward to this great session. Thank you. You're welcome. Yes, great job explaining. Thank you, guys. I appreciate your time. Can you guys do me one favor? One thing I ask of you guys, if you guys enjoyed this, if this was helpful, just in the chat room, just share your thoughts. All right, just share your thoughts in the chat room just to encourage others. So just want to know, so everybody can understand and know that this isn't a scam. This isn't, anything. We're actually learning and working here. And on top of that, make sure you guys go and subscribe to my YouTube channel. For those that are on YouTube, make sure you're subscribing. And then I thank you guys for spending your time. It is a Friday night. For those that are watching and you're going to be watching on YouTube, it is a Friday night. And for everybody that's stuck around, I appreciate you guys for your time. And thank you. And I hope you have a great weekend. All right, guys. Thank you for your time, guys.